When you're looking at the tech sector in particular, how important are dividends? He mentioned NVIDIA has the lowest dividend of all the stocks in the tech sector, but as I pointed out, price appreciation pretty good there.
Well, it's certainly an interesting fact, but I'm actually not sure it's all that important. What I think is really important, and more so maybe perhaps in technology stocks, is the ability of a company to generate free cash flow and return that free cash flow to shareholders. And so whether a company actually does that in the form of a dividend or not, I'm not sure that's important. What we really want is for a company to be able to grow that free cash flow over time, and then the share price should follow. So whether it's through dividends, whether it's through share repurchases, or whether we're doing sort of synergistic acquisitions to promote growth, we just want that free cash flow to grow over time. I don't think it's actually particularly important whether a company pays a dividend or not.
All right, fair enough. I mean, everybody has an opinion about dividends. I want to turn back to what's really the hot topic when it comes to tech and the broader markets right now, that over-concentration, specifically tech showing so much leadership, just 5 stocks leading to about 60% of the gains on the S&P so far this year, which has once again hit a fresh record high. How do you view this concentration right now? You actually gave us a stat. This is pretty interesting. Very similar to what Mike Santoli put in his weekend column. About half of the stocks in the S&P 500 are actually below their 100-day moving averages, while the broader index is well above its 50-day. What does that say to you?
Well, I mean, it just tells us that that narrow market is becoming more and more prolific. And, if you look, it's concentrated within the tech sector. Just as a fact, it's just growing to be a more and more part of the US market. And if you look at the NASDAQ, for example, you've got around half the companies in there are actually below their peak from where they were back at the end of 2021. So that effect of a higher interest rate environment is taking its toll on companies. You're just not seeing that below that headline level. But the thing is, whilst it's a challenging environment for active managers, it's actually also a really exciting environment, because what that means is you've got more and more companies underneath the surface trading at more reasonable valuations, which means if you're selective and invest in the right ones, you can improve your return expectations from here.
By the way, Hannah, I haven't heard whilst since I've been in London. It's great to hear you say it. It kind of brought me back to those days. You actually gave us some picks today, which I think are really interesting. And you say they're tech, but they're kind of not really tech. One of them is Fiserv. The other one is TransUnion. Just give us very quickly the elevator pitch on both that are tech, but not really tech.
So the thing with both of these companies, Frank, is they're both exceptionally high quality businesses, and they have lots and lots of data. And that's the real key behind artificial intelligence, which I know you're talking a lot about today, is that access to data. For Fiserv, they provide the fintech sort of data behind thousands of banks in the US, and they also provide merchant and point of sale solutions. And so they can see both aspects of a consumer, both on the front end of where you're making that payment and on the back end from the banking software side. So they have huge amounts of data which they're able to monetize. It's one of the largest positions in our strategy. It's actually outperformed the global equity market substantially over the last 2 years, up around 75% versus 45% over the market, and also over the last year. So it's done exceptionally well, but it's still trading on a very reasonable valuation, about 6% free cash yield. TransUnion is actually classified as an industrial company, and that's really exciting. I think there's a lot of worries around the credit bureaus at the minute because of the macro environment. But actually, if you think about the nature of a credit bureau, they have access to thousands and thousands and thousands of underlying customers and all of their data, which they can then monetize for income verification or fraud or risk management. So they're really exciting businesses, again, trading on close to 7% free cash yield. Very, very high barriers to entry and a huge economic moat for that business. And it's just underappreciated in this market environment. So I think that from here, they could offer a lot better returns potentially versus what's an expensive market.